we are going to look at a question on consolidation. In any long consolidation question, you need to look at a few things before you start. So first of all, you're going to look at the acquisition date. In this case, it is 1st of January 2009. Notice that in most of the other questions that you have done in the past, the acquisition date is normally 1st of July. So how come this one is 1st of January? The reason is because if you look at the end of this page, the reporting date of this group is 31st of December, which means that for the financial year for this group is from 1st of January to 31st of December. So later on when you look at depreciation and also intra-group transactions, you need to be aware of this particular information. The next thing is to look at what is the reporting date. The reporting date of this question is 31st of December 2011. So from the acquisition date to the balance date of this current year, it has been 3 years. So again, you need this information in order to prepare journal entries later. Finally, because this question has NCI in there, so before you start, you need to look for whether it is a partial goodwill or a full goodwill method. So in additional information D, you can see that in this question we have full goodwill method. So those are the few things that you're going to look for before you start. So the first part of this question, we need to write down the acquisition analysis. So with acquisition analysis, as you all know, we need to compare the fair value that you acquire to the purchase consideration that you pay in order to work out the amount of goodwill. But remember, in this question, we need to calculate the full goodwill. That means we need the goodwill for the parent as well as for the NCI. So we're going to start with this acquisition analysis by writing down the net fair value of identifiable net assets and liabilities. So with the net fair value, we have capital, general reserve, and retained earning. So that's the starting point of the question. So for this one, we got 120,000 capital, 20,000 general reserve, 40,000 retained earning. So that's all the fair value of the equity. After that, we need to write down the fair value adjustment of assets and liabilities. Going back to the question, you can see that in this one we have machinery as well as land. So we need to adjust the carry amount to the fair value, which in this case you can see that for machinery we have a 10,000 increase, while for land we have a 30,000 increase. And before you write down the fair value adjustment, you should look a little bit further to see whether we have any additional information about other assets and liabilities. In this one, if you look at the next paragraph, you can see that that information is also about machinery and land. So that means that in this particular question, we only need to adjust the fair value of machinery and land. So for this one, we have 10,000 after tax. That's for the machinery. We also got 30,000 for land. If you add up the net fair value of equity as well as the asset revaluation, the total would be 208,000. So this is net fair value. We want to compare with the consideration transfer, which is the purchase price. So in this case, going back to the question, you can see that the purchase price was 160,000. But remember, this is a question of full goodwill. So in addition to the parent's amount, you also need to find out the NCI fair value. So go to additional information D, you can see that the fair value of NCI was $66,000. So we need both of this information in the acquisition analysis. So we got the consideration paid by the parent, 160,000. And then we got the NCI fair value, which is 66,000. That means in total, The value offered by the parent entity as well as the NCI is 226,000. Then we compare the total with the net fair value. The difference there would be the amount of goodwill. So in this one, the amount of goodwill equals to 18,000. And remember, this particular goodwill is the full goodwill. And we need to allocate the full goodwill into parent and also NCI. Very importantly, in this question, parent entity owns 70%, but that doesn't mean that they will get 70% of this goodwill, because we need to do the calculation for parent and NCI separately. So with the parent calculation, we need to use the 160,000 paid by the parent minus 70% of the fair value. So if you do the calculation, you will have 14,400. So that's the amount of goodwill you want to allocate to the parent entity. And we are going to do the same thing for NCI. So with NCI, the fair value was $66,000, and then this time we want to minus 30% of the net fair value, 208,000. So the amount of goodwill you want to allocate to NCI is 3,600. Okay, so that's all you need in terms of the acquisition analysis. And this part is very important because a lot of this information will be very useful when you prepare journal entry later on. So as you all know, the next part of the consolidation process is to prepare the BCVR journal. So the BCVR entries, we want to adjust the fair value of assets and liabilities. So what do we need to do? Going back to the acquisition analysis, as you can see that we got machinery, we have land, as well as goodwill. So these are the three assets that we need to prepare journals for BCVR entry. Then we go back to the question and to find out what happened with those assets. So if you look at this particular paragraph, you can see that with the machinery, it had a further 5 years of useful life. And that didn't say that they sold it. That means they kept the asset. With land, it was sold on 30th of June 2011. Very importantly, when they say they sold something, you need to find out when did they sell that. 30th of June 2011, right now is 31st of December 2011, which means that this one is current year. In other words, we will need to prepare the journal entry for that particular sale. So first of all, we need the journal entry for machinery. With the machinery, because they did not sell the asset, so we need to prepare the original journal by revaluation. So with this particular one, we have original cost of 100,000 and then carry amount of 70,000, which means that we will have accumulated depreciation of $30,000. So that will be the starting point, and we want to reverse this accumulated depreciation. So we want to debit accumulated depreciation for $30,000. So that will be the first part. The second part of this journal is to adjust the cost to fair value. The cost of this asset was 100,000 and the fair value of this asset was 80,000. That means we want to adjust that downward by $20,000. So we're going to credit machinery by 20,000. The actual revaluation, as you can see from the acquisition analysis, was $10,000. So 30% of that will go to DTL, and then 70% will go to BCVR. So as long as we have this asset on our financial statement, you need to repeat the same journals every single year. The question also says that they need to depreciate this asset. So going back to the question, it says that it has a 5 years of useful life. Okay, 5 years. And going back to this working, you can see that it has been 3 years later. That means we need to adjust the depreciation for 3 years. So the revaluation was $10,000. 10,000 divided by 5 is going to be $2,000 per annum. And it has been 3 years. So for the current year, we're to debit depreciation expense, 2,000. And then for the prior years, in this case, there will be 2 years. $4,000 is for the 2 years of prior depreciation. And then we want to credit accumulated depreciation. So you adjust for 3 years of depreciation, and every single one of them will also need the tax effect as well. So we need to gradually reverse the DTL. So the DTL will be 30% of $6,000. And also we need to reverse the income tax expense as well as retained earning, which is $600 and $1,200. Before we go any further, as you know that this is a question with NCI. So with NCI step 2 and step 3, we need to make adjustment for retained earning as well as profit. It's quite useful when you prepare the journal entries. Along the way, you try to identify what sort of adjustment that we need later on. In this question, BCVR entry is about adjusting the fair value of assets and liabilities of the subsidiary. So when any journals in here is going to affect retained earning or profit or loss, we know that later on is going to affect NCI as well. So for example, in this question, if you look at this journal, these 2 journals, you can see that it affects expense as well as retained earning, which means that it's going to affect NCI. So we're going to write down step 2 and step 3 affected for NCI. With step 2, it's going to affect retained earning. How much is that? Looking back in the journal, we have 4,000 debit retained earning, and we also credit retained earning by 1,200. So in total, it's going to decrease retained earning by 2,800. Also, in terms of profit, we recognize depreciation expense by $2,000, and then we credit income tax expense for $600. So it's going to affect profit. After tax is going to be $1,400. So it's quite helpful when you do that along the way. Okay, after that, we need to look for another journal. So in terms of this one, we need to look at land. With land, based on the original question, it says that they sold the asset in the current year. So we need to reverse the gain on sale. So the journal entry, we need to debit gain on sale. So the amount of fair value adjustment was $30,000. As a result, when we remove the gain on sale, it's also going to be $30,000. After that, we also need to reverse the DTL as well as the BCVR. So we reverse the DTL through income tax expense. So there will be 30% of the amount, $9,000. And we're going to reverse the BCVR through transfer from BCVR. Which will be 70% of the amount, $21,000. Okay, once again, before you go any further, you need to decide, is it going to affect NCI? With this one, you debit gain on sale, which means that you are going to affect the NCI profit. So here we're going to write down NCI step 3. And it's going to affect profit. So when you debit gain on sale, it means that you want to reduce the amount of profit. So after tax, the amount is going to be $21,000. So that will be the journal required for land and also the NCI adjustment. Finally, because this is a question of full goodwill, with any full goodwill question, you want to recognize the goodwill under BCVR entry. So based on the acquisition analysis, the amount of full goodwill was $18,000. So we're going to recognize goodwill, debit goodwill, 18,000, and then credit BCVR, also 18,000. and there's no additional information in relation to this goodwill. So that's the end of the BCVR entries. The next part is going to be pre-acquisition entry. So with pre-acquisition entry, we want to eliminate the parent share of the net fair value, the pre-acquisition equity, against the investment by them. So again, we're going to go back to the original question. You don't actually need to go back to the question. You can just look at your acquisition analysis, because in your acquisition analysis, this whole bit there, you want to eliminate them. Because for this one, we want to eliminate all the equity, including the BCVR in there. So we can base on this information and then multiply by 70%, which is the ownership by the parents, and then we can prepare the journal. So for example, the amount of capital, we want to reverse the amount of capital. The calculation was 120,000, which is the original amount of pre-acquisition equity, and you want to eliminate 70% of that. So the amount that you want to debit is 84,000. And we are going to do the same thing for retained earning as well as general reserve. With retained earning, there will be 28,000. Then general reserve, there will be 14,000. So these three amounts will be very straightforward. After that, we need to look at BCVR. So BCVR will require a little bit of calculation. With BCVR, there are three components that we want to eliminate. The first one is the machinery. Based on our journal, we recognize 7,000 of BCVR, 70% will belong to the parent entity. After that, we also got land, which is 21,000, also 70%. Finally, we also need to add the goodwill as well, but be careful, because this one we want to look at the amount of goodwill that belongs to the parent entity. Going back to the acquisition analysis, you can see that the amount of goodwill was 14,400, and you don't need any additional calculation on that. So we're going to write down 14,400, and that's the amount of goodwill. So the total amount of BCVR that we want to eliminate equals to 34,000. On the credit side, we want to reverse the investment in subsidiary, which in this case, the parents invest $160,000 to pay for that 70% of interest. Very importantly, this is a very long journal that requires separate calculation. So in any long journal, it's very important that you try to add up the debit and try to compare to the credit to see whether it is balanced. If it's not balanced, then you need to go back to check whether you miss an item or miscalculate an account. So that will be the main journal for pre-acquisition entries. After that, you got to look for the changes. For the changes, there are two main possibilities. The first one will be about BCVR. The second one is about general reserve. And we can check whether they actually happen. In terms of BCVR, all you need to do is to go back to your original question to see if you have sold the asset. In this case, we can see that you sold the land. And more importantly, you sold that in the current year, which is why you will have an entry of transfer from BCVR in terms of land. So with this one, we need to reverse this account. And once again, remember that the parent entity only owns 70%. As a result, you only want to reverse 70% of that transfer from BCVR. So we've got to debit transfer from BCVR and credit BCVR. And the amount equals to $21,000, which is the original, and then we want 70% of that, which is 14,700. And remember, this particular entry is about the BCVR related to land. So that's one of the possibilities. The other one that you need to look for would be the general reserve. How do we find out whether it's going to affect the pre-acquisition entries? First of all, if we go back to the original question, the amount of general reserve at acquisition date was $20,000. So we start with $20,000. You want to compare this amount with the amount that we have on the financial statement under subsidiary. You can see that in this one, under subsidiary, the amount of general reserve is also $20,000. That means there's no change in general reserve in the last 3 years. Let's say in another question, if you notice that there's an increase or decrease, it still doesn't mean that you need to prepare it under pre-acquisition, because in additional information, you will notice that they will tell you whether this is a pre-acquisition transfer or post-acquisition transfer. Only pre-acquisition transfer will be recognized under pre-acquisition entry. But in this case, we don't have any change anyway, so we don't need any additional journal for general reserve. And that will be the end of pre-acquisition entry. One more thing, with this one, because you adjust the BCVR and you know that the remaining 30% of that BCVR belong to NCI. So as a result, you are going to write down NCI. This is going to be step 3 because it happened in the current year. And the amounts will be 21,000 times 30%, which is 6,300. So later on, when we prepare BCVR entry for NCI in step 3, we need to prepare this particular journal. So we'll do that a little bit later. After the BCVR entries, the next part would be intra-group transaction.